Ever wondered what moves the world's economy beyond just stocks and bonds? Welcome to the massive dynamic world of global commodities. This is the market for raw materials, the very building blocks of our daily lives, traded in huge quantities across international exchanges. Think of it in four main groups: energy, metals, agricultural products, and livestock. For investors, commodities are a fantastic tool for diversification because their prices often move independently of the stock market. Let's break it down. The most traded commodities are in the energy sector. You've probably heard of WTI and Brent crude oil, natural gas, and heating oil. These fuels power our cars, homes, and industries. Then we have metals. This group is split into precious metals like gold and silver, which many people buy to protect their wealth against inflation, and base metals like copper and aluminum, which are essential for everything from construction to electronics. Next up are agricultural commodities, often called softs. These are the staples we eat and wear every day: wheat, corn, soybeans, coffee, sugar, and cotton. Finally, there's the livestock category, which includes assets like live cattle and lean hogs. Each of these has its own unique story and market drivers. Now, why are traders so drawn to commodities? One word: volatility. Commodity prices can swing dramatically, and this movement is driven by the simple law of supply and demand. But here's the catch. Unlike a factory that can ramp up production of smartphones, you can't just create more coffee beans overnight if a frost wipes out a crop. This delay between production and demand creates a buffer that, when it gets tight, can lead to some wild price swings. To measure this risk, traders use a statistical tool called standard deviation. Think of it this way: the higher the standard deviation, the more volatile the price, which means a higher potential for both profit and loss. This is especially true when trading with leverage, so understanding this risk is absolutely crucial. It's all about navigating the messy path towards a fair price. So, how can you get involved? There are a few main ways. First, there are futures contracts. These are agreements to buy or sell a commodity at a set price on a future date. Producers use them to lock in prices, and speculators use them to bet on price movements. Then you have options, which give you the right, but not the obligation, to buy or sell at a certain price. This can be a more flexible way to trade. For those who want broader exposure without handling individual contracts, there are exchange-traded funds, or ETFs. These funds track a basket of commodities, giving you instant diversification. And for many retail traders, contracts for difference, or CFDs, are a popular way to speculate on price changes without ever owning the underlying asset. No matter which path you choose, successful trading boils down to strict risk management. The legendary trader, Jesse Livermore, always said it's vital to cut your losses early to protect your capital for the next big opportunity. The key is to understand the unique personality of each commodity. What drives its price? Is it geopolitics for oil, or weather patterns for soybeans? By digging into these supply and demand fundamentals, you can make much more informed decisions. This is just a glimpse into the fascinating world of commodities trading. It's a market that rewards deep understanding and disciplined strategy. If you found this helpful and want to learn more about day trading and swing trading strategies, please hit that like and subscribe button. Thanks for watching.